As we're looking through the QuickPricer or the Quick Value tool, I've just picked an industry and pulled some comparables out to keep it simple. But I'm looking at the P&L for 2004 as an example from a real life business, and I plugged them into the QuickPricer. You do this for the last 3 or 4 years, at least 3 years, usually to give you an idea of direction of sales and some other factors, but it gives you an overall perspective. Now, instead of using the complicated valuation software, I just plug in the revenues and take away the cost of goods and then I get the gross profit. I pull that from here, from the P&L. The total revenues, they match there. The cost of goods, 460 there. That gives me the gross profit, which is right here, and then I come down to the bottom and I pull the total expenses, and I put that in, and I get to 152, which matches this number. Now, I could have just gone right to 152 and done all the nonsense, but I kind of like to look at the pattern that will develop when you do 3 years. What are the percentages of margins? What are the percentages of the direction of sales? Are they going up or are they going down? Are they going like a snake across the land? Same thing for the cost of goods. Are these numbers typical? And in the space you can see the percentages if you blow it up a little bit. But I make that a minor element of what I'm looking for. And then I go through and I look at everything item by item by item, and I make notes, and I start off with some assumptions, and then I go back to the seller. Sometimes I do it with the seller, but if I don't have the seller and I've done this on my own at the office, I'll go back and I'll say, hey, I saw that we had some expenses out there. So let's say that they paid themselves $80,000, or the owner did. And there was interest. I pulled interest off there. If depreciation and amortization are on the P&L, or if you're doing this off a tax return, which you can, then depreciation, amortization automatically go back. They're a non-cash entry. There's something that the government allows so that people pay less taxes to incentivize them and to help them through the process of acquiring more assets and growing their businesses. It's kind of a nice thing to do. Interest is also added back always, as long as it's interest towards paying the expenses in the business, because someone else might get a loan, but they're going to need a different loan most likely, and those things will be all wiped away and somebody can start new. Now, these people had pretty high automobile. I just left it in there at that amount. They had some health insurance that was personal, and so we thought it was about $14,000, but they had much more than that, 23 or something like that. Some of it went to one of the employees. So we added $14,000. That's an estimate. I put EST so I'd remember that. Meals got added back and travel got added back. Now, not all meals get added back. If you use meals for you and the spouse or the owner and the spouse to go out and eat and chat about business, and they're writing this thing off, if they're doing something like that, then that usually gets added back because it's not essential to the operation of the business as it's being run up until the time or prior to the years going up to the time of the sale. If for some reason something like meals were used to incentivize the employees and celebrate holidays or congratulations or birthdays or what have you, or if they were used to woo customers, then they would have to stay in the business and they would be a normal type of expense. Same thing for travel. If they traveled and they had to drive the car around to do different clients, then that might be something that you don't get to write off as well. So just ask yourself on each of these and then speak with the owner and say, well, what seems to make sense in terms of what we're talking about here, and make sure it makes good common sense before you make the adjustment. Or make the adjustment and then write some notes down and then keep notes. Like I have a section on here just for notes itself. It's not on this sheet, but we can call this one notes and create a sheet for notes. As you talk to the owner, have a record of it and share that with the owner, saying, hey, I heard you say that you paid yourself $80,000. I heard you say that there were no expenses for meals that were used for the employees, etc. And do some rock solid science. Anyway, bottom line is we get to these numbers. So I've added back all the numbers and I got 379. I went to some comparable data, and this came from peer comps, but it doesn't have to come from peer comps. It can come from other resources as well, but I like peer comps a lot. And then I often go to the median, but these are pretty close, median and the mean, which is the average. Median is the middle number. And I put in the 272 multiple of SDE, put it in there. I took the multiple of EBITDA, and I put it here for reminders. EBITDA varies from SDE primarily by the fact that they're spending money on an owner to operate it. So if you had one working business, you're working in the business itself as the owner, then you might keep all these profits. But if you have multiple locations, you're going to have to pay a manager to run the business, and you'd go to the marketplace and determine what the average is. I just made up some numbers as the example. And so you can see this business could be priced somewhere between, 1 million and 1.125 or 1.15 or something like that. Okay? Now I'm just averaging these numbers up. I hope this is helpful to you. Thanks.